If you're selling your rental property after years of managing that property, watching it appreciate, the last thing you want to do is be shocked when you sell it and the impact that capital gains and depreciation recapture can have on that sale. There are a lot of tools out there. So if you're going to sell that property, you need to do some planning. There's part of a tax code called Section 1031, which enables you to defer the taxes from your sale. A lot of investors are shocked when they speak with their CPA and find out that they have almost a zero cost basis in their property. As an example, on $1 million, if you're selling a property and you've been doing your job as a landlord, so when you receive that income, you and your CPA have been depreciating your property so you don't have to pay tax on the income. It's a great reason for owning real estate, because here's something you purchased, it appreciated, you used the original sale price to depreciate your property to avoid any of the taxes owed on the income you're receiving on the property. But the IRS, they want their money back. They think that that money belongs to them. And the only way to avoid that big tax, depreciation recapture can be 25%. So just on $1 million sale, right, you could have $250,000 of depreciation recapture, let alone the capital gains. And who wants to give all that hard-earned money to the IRS when that money, that portion of that money, can generate wonderful income for your retirement? So part of the strategy here is understanding what that tax bill is going to be. So speak to your CPA first, find out what your adjusted cost basis is on the property, what the capital gains and depreciation recapture is going to look at, so when you get that offer to sell, you understand, okay, I might be receiving $1 million for the sale of this property, but I'm only going to get to keep $600,000. And that's when strategies such as doing a 1031 exchange to defer all those taxes can be incorporated into your plan. Now, what if you say, hey, that's great, but I don't want to manage property? Well, the good news is that there's products out there, one in particular, Delaware Statutory Trusts. These are large, institutional size properties that are put in a specialized trust that qualifies for the 1031 exchange, and you can buy any amount. So you can buy a fractional position. So if you have $1,295,000, you can match that down to the penny. So instead of receiving income just on $600,000, right, you can receive income on the full $1 million of your sale. So that $400,000 of money that you didn't give up as taxes, even at 5% off the top of my head, that's $20,000 a year at 5%. Who doesn't want an extra $20,000 a year of income? So planning before you sell your property is very important. Utilizing the tax tools that are available, Section 1031, and either going out and buying something like a triple net lease or a DST, a Delaware Statutory Trust, you can receive that gross monthly income off of the gross sale of your property instead of the after-tax amount. So planning is very important. Maximize your retirement income. If you like this video, hit like and subscribe and check out our other videos.